The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The economic growth narrative begins to fray at the edges. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Vostek.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. The losses accelerating this afternoon as we continue to monitor the fallout in equity markets. You have the S&P 500 losing 3.33%. It's now at a 6-month low and losing almost 9% since its record high in late February. It's on track to close below its 200-day moving average as well. The Nasdaq 100 losing 4.4%, the biggest one-day decline since September of 2022. And of course, there's buying of treasuries, which is higher prices, lower yields. The 10-year yield coming down almost 9 basis points to 4.21%, and Bitcoin getting caught up in the risk-off sell-off here. You have crypto trading as a risky asset, currently below $78,000 remain.
The risk-off sentiment, of course, tied to the macro all weekend long. We heard from the administration all weekend long. They had a similar message. President Trump talking about economic transition. Treasury Secretary Scott Bessent talking of a detox period. But all the market could hear was not detox, but stagflation. Not transition, but recession. One of the only cabinet members who really tried to push back on that narrative was Commerce Secretary Howard Lutnick, who, well, said, don't worry. Right now, on Meet the Press, he said there is not going to be a recession here in America. But for right now, the market really isn't so sure about that. And the case in point is really the price action. No idea what's in the hearts and minds of traders, but the economic risks from policy changes in Washington, they've reached a height that is finally causing a material rethink in the price action on Wall Street. JP Morgan strategists warning that their year-end S&P forecast, 6,500, that may not materialize. Lori Calvasina over at RBC lowering her bear case for the index to 5,600. Mike Wilson at Morgan Stanley saying the next support level for the index, that might actually be closer to 5,500. And this is not just an academic exercise either. Short-term Treasury yields down 25 basis points from just 2 weeks ago, 40 basis points from just before Trump's inauguration. The Nasdaq 100 today poised to close in correction territory for the first time since September. And the S&P, which last week was the globe's worst performing major market, poised to now close below that 200-day moving average, Scarlett, for the first time since 2023.
Yeah, so clearly a lot of key technical levels are in play here. The question is, how orderly is this sell-off? So yes, the price action is pretty dramatic and one-sided. This line is the S&P 500, and since its record high about 2.5 weeks ago, it's been down, down, and down. And when you look at the percent of index members that are lower, about 3 hours ago, less than half. Now, more than 2/3 at 72%. But there is still a rotation into defensive names inside consumer staples like food and household products makers, as well as utilities. And in the past 3 months, what we've seen is that at least 75% of the S&P 500 members falling more than half a dozen times. So we've definitely been here before and recently as well. And Romaine, the dip buyers have reliably been coming in.
Yeah, and that's a big question as to whether they will come back this time around. Amy Wu Silverman joins us to kick us off to the close, equity derivative strategist at RBC Capital Markets. Amy, is this for real this time, this sell-off?
Certainly feels like it. Look, it's when we look at our world, at VIX, at correlation, at dispersion, you know, so far it's been relatively orderly, but there's only so many times you can say that as we go 1, 2, 3 standard deviations off in terms of drawdown. There is going to be a period where I think it's going to be panic at the disco. We haven't gotten there yet, but, you know, as these levels climb, there will be unwinds and more uncertainty that triggers even more.
There was a lot of talk here about some of the technical levels being breached and the idea that that might actually bring some buyers back into this market. We've pretty much tested the 100-day on everything, the 200-day now in play on the S&P. Is that going to be potentially some level of support for this market?
You know, I will tell you anecdotally, I keep asking if anyone is buying the dip from people who could potentially buy the dip, and they haven't been buying the dip. So they want to know if anyone else is. And my question there is, when you look at kind of historically where you see that buy the dip or you see that FOMO and momentum, it's usually in those call option wings. You're not seeing people step in there yet. Even historically retail, which tends to lead that, we have not seen that yet. But again, we haven't seen this mass panic flight to hedges. We've seen very orderly hedges. You mentioned panic at the disco. What are the markers of panic at the disco? I think from where we are here, so obviously VIX has spiked, you know, and we've seen a rise in correlation into the 30s. Historically, when you think about Volmageddon, when you think about the global financial crisis, when you think about August 5th, these indicators, they can go into the 80s. So it feels substantial, and it is when you look at it on a year-on-year basis. But when you look past a history 5-10 years out, these indicators can go substantially higher than we are now, Scarlett.
The other thing is, you think about what's going wrong in the world from equity bulls' perspective. You have tariffs and the uncertainty over that, geopolitics and government firings and what that means for the employment picture. These are all known knowns. Things that typically push the market off the ledge are things that are complete surprises. How does this set us up in terms of the market's fragility and the mindset as, we try to price in things, or I should say we try to absorb things that are unexpected?
Yeah, I think that's so interesting because that nuance is really important. Meaning, when you think back to August 5th, right, that was sort of like an unknown, like a volatility pothole that just hit the market. The same thing with February 2018 when we had that VIX ETP unwind. Whereas here, this has really just been a mispricing on the investor side, but it wasn't like they didn't know what was going to happen. We knew since November elections that tariffs were on the table. We just somehow magically thought it was all going to be okay. And so that fundamental change, I think, does make a difference here. Perhaps that's why you've seen kind of a very orderly year-to-date sell-off. That said, you get to certain levels where people have been kind of complacent in their trades, in certain trades that have essentially relied on low correlation levels, high dispersion levels, relied on things kind of staying the same. And as you continue to sell off, I worry that that will trigger in and of itself something that is potentially worse, that unknown coming into the picture.
And we've seen stock correlations rise pretty significantly here. We also saw, at least last week in the backwards looking data, we did start to see a lot more people look for hedges in the options market and elsewhere. You're seeing that too in your data?
I certainly am. And I would tell you, the big debate we're having right now in options land is this going to look more like a 08 or a 2018, or is it going to look more like a 2022? And what I mean by that is in 2022, we also had a 20% drawdown. But when you looked at systematic hedging, it actually managed to draw down 21%. So it's kind of a fail. Like, option prices did not do what they were supposed to do. And the question is this year going to look like that, where we have to be more systematic or not?
What was the starting point, though? Because I was under the impression that coming in, at least buying downside hedges, at least, if you were smart enough to do it, a month ago, you could have done that relatively cheap, right?
And to be clear, they have been working.
Okay.
So already we don't look like 2022. But the question is, are we going to end the year with more? I don't drive, but I love these driving analogies. Are we going to end up with these like sudden potholes, or is it going to be kind of this like dreary march towards, low and lower from 5,500?
Same. I don't drive anywhere. Not in this town.
You're New Yorkers. Okay, so this is typically a weak period for equities. We've been hearing people say that a lot. What does that mean in terms of how we determine when we're near a bottom? Because people will be looking at the calendar saying, but we're not there yet, because it doesn't happen around this time of the year.
That's fair, but I would say there are certain strategies you'll start to see, not become a trickle but a flood if people start to believe that we're near the bottom. So one would just be call buying. Mm-hmm. Because if you think about your NVIDIAs of the world, your Mag 7, your Teslas, this is usually where you see people step in and say, I'm going to buy call options, or I'm even going to underwrite. We haven't seen that type of activity yet, but that has been very prevalent post-COVID in these stocks. And those are markers that we've come to rely on to say, now we're much more focused on the right tail. Now we're much more focused on the upside versus the downside.
How much are you paying attention to the 200-day moving average? It's been noted that we've held above that level for 336 days, and people keep saying how nothing good happens below the 200-day moving average. What does it signal to you?
It's interesting because I have changed my mind over time, but I really think technical analysis is just psychological self-fulfilling prophecy. Meaning, if people think that is that important and then we break it, you will see that panic occur, essentially because they believed it to begin with. And to me, that's sort of the crux of technical analysis, in the sense that it's all behavioral finance at the end, because it's all people behind their computers. And so I do think there's a lot of importance to that, especially if you start to see that open interest float in that area.
I don't know. Were you supposed to say that out loud? Because I've always believed that as well. But sometimes those self-fulfilling prophecies, they are, in a certain degree, a true reflection, I think, of at least how people want to sort of price this market. And it gets to the idea that if we do see some opening for a rebound or for dip buying, are we going to go back to the levels that we were, I don't know, say 2.5 weeks ago before kind of the sell-off really took place? Or is this going to be one of those things where, we lose 10% and gain back, 2 or 3 percentage points?
I think it's going to be much bumpier because the problem is right now we're still in the fog of, okay, there are tariffs, but they've been suspended for a month. But what's the exact implementation? Like back in November, we got to wishfully think that this is going to be okay. Now we're down to the devil in the details.
All right, Amy with Silverman, always a great conversation. Equity derivative strategist at RBC Capital Markets. As stocks now hitting session lows here with major declines across all of the major moving averages. And a lot of this has to do with economic conditions and tariff jitters. Those jitters reverberating across the markets right now. We're going to dive deeper into that impact with one of America's biggest restaurant chains, Chipotle. The CEO, Scott Boatwright, joins us in just a few.
And within all the red of today's sell-off, Novo Nordisk having an extremely ugly day. You could see they're lower by almost 10%. Why the company's next generation diabetes shot fell short of expectations.
And one of the worst performing sectors on a year-to-date basis, consumer discretionary stocks. We're going to check in with the head of Sandals Resorts. Adam Stewart is going to join us and give us his take here on whether people are still willing to spend on the ultimate discretionary item, vacation. Stick with us. This is The Close on Bloomberg.
All right, less than 50 minutes to go before the market closed, and stocks have been on a steady downdraft, now at session lows. You can see the S&P 500 losing 3.4%, but the S&P equal weighted index, look at that, less than 2% lower. Joining us now to discuss is Gina Martin-Adams. She is chief equity strategist for Bloomberg Intelligence. And Gina, there is a rotation taking place within the S&P 500. 378 names are down, but 124 are up, and you've got telecom services, household and personal products, food, beverage, and tobacco companies rising.
Yeah, and I think that's really been the story since last summer, frankly. It's just been the rotation has been amplified by policy so far this year. So really, if you go back to last summer, we saw some pretty big cues from our sector rotation model suggesting that tech was going to take a back seat to the rest of the sectors. We did see that rotation emerge in the second half of last year with financials and industrials starting to perform well. Now we're seeing more rotation into defensives, but the one consistency throughout that period is tech underperforming. And when you have a market where tech is actually not only underperforming but falling, it's next to impossible for the S&P 500 to rise. It's just too big in market cap concentration. So the loss of faith in tech is a big part of this story. If you take the Mag 7 alone, since their peak in December of last year, they're down 16%. So that's a very, very big loss for the biggest market cap stocks in the S&P, and it's certainly weighing on confidence.
Whenever you see a broad sell-off, you see volume spike, and that's no different today. You have the S&P and Dow showing volume at least 60% higher than the 100-day moving average. But for the Nasdaq, it's only about 3% higher than the 100-day moving average. What do you think that means?
I have no idea what that means. I don't use volume very much in my work. I find it to be somewhat unreliable given the program trading that's out there, and also we trade so much in baskets of stocks as opposed to individual stocks. It's really hard to use it for an indication. I think the things that are most relevant right now are all related to earnings. We came into this year with the market anticipating greater than 20% earnings growth. We were writing about this in December as much as we possibly could. That is next to impossible for the market to achieve. And we're experiencing the reality of the index is probably going to create somewhere closer to 10% earnings growth over the course of 2025. That's a really big downshift in expectations that has to get priced into the equity market.
When does that start to show up, though, in people's forecasts? There was a great story on the terminal today about, some market strategists, they're rethinking their year-end price targets, but not necessarily willing to sort of pull the trigger yet in downgrading that. And similar story with their calls for earnings on the S&P 500. It's still relatively early in the year, still relatively early in this administration. And if you believe what they have to say, they're saying some good is coming when it comes to policies that maybe ends up bolstering, if not the economy, certainly the bottom line of these companies.
Yeah, I can't really answer the question as to how other strategists approach their business. I can tell you that for our approach, we run fair value models, and our fair value models have been saying the S&P 500 is dramatically overvalued. That's where we get our indication that the market was priced for greater than 20% earnings growth. We have to get to a point where the market is pricing closer to 10% earnings growth, which means we need to get down to somewhere between 5,200 and 5,400 on the S&P 500.
But when you made that call, I mean, that was prior to
Yep.
the inauguration. Did you already factor in the potential of some of the Washington policies?
Well, no.
Okay.
This is just earnings reality and the underlying conditions in the economy, which frankly haven't changed that much. So we're getting very caught up in economic headlines. But if you look at things like the ISM survey has actually improved. The S&P's manufacturing survey has actually improved over the course of the last few weeks. When we look at sentiment inside transcripts, it's generally pretty solid. There's no massive change in the underlying economic picture that is really driving this. It is about expectations. And it is about, over the weekend, the president came out and said, I no longer am the put to the S&P 500. You can't assume that just by stocks falling, I'm going to change my policies. I think that is incredibly important. This is about expectations and sentiment, not necessarily about underlying conditions. Sentiment was extremely frothy. Underlying conditions could get worse. And maybe that's your trigger point for people really changing their forecast. But this is more about sentiment, more about how we need to right size our expectations for the policies that are emerging. With respect to your second point, the president may be promising something better coming, but hope is not a strategy. And right now we have a lot of uncertainty. And until something actually emerges, it's really difficult to price that.
All right, Gina Martin-Adams, one of the best in the business, chief equity strategist for us here at Bloomberg Intelligence. As we keep an eye on the markets, which continue to drift lower, we're going to focus on maybe some salvation after the market close. Earnings out of Oracle, a big conversation about AI and cloud demand, whether that spending can help to lift this market. That's coming up next on our top calls. This is Bloomberg. The majority of stocks in the red on this day, but there are a few bright spots. Let's get to our top calls. Some of the big movers on the back of analyst recommendations. And we start with Cracker Barrel, an upgrade to buy over at Truist. The analysts actually praising the restaurant chain's solid turnaround plan, menu innovation, and improved customer service. No commentary in there about tariffs. The shares, though, getting a nice bid, up 4% on the day. Next up, a buy for server company Supermicro as Rosenblatt Securities reinitiates coverage. The analyst saying Supermicro has a formidable business model and views its ability to deliver liquid cooling technology for servers as a competitive advantage. Those shares are moving on the day, and you're taking a look there at KeyCorp, which also got an upgrade today to buy, though you're seeing KeyCorp shares down about 4% on the day. We do want to go back to the technology space and push ahead to what's happening after the bell tonight. Earnings from Oracle, a big one. The stock, of course, rallied about 20% in the middle of January. It's down about 20% since. A lot of questions here about the AI spend and whether Oracle is a beneficiary of that. Brent Thill joins us right now, software and internet research analyst at Jefferies. He currently has a buy rating on Oracle. All right, Brent, should I get my hopes up for tonight? I mean, Oracle has kind of thrust itself back into the zeitgeist, at least when it comes to the AI and tech spend here. Is that going to show up in the numbers and, more importantly, the forecast tonight?
We think it is. We think that their backlog growth will continue to be strong, fueled by AI investments. And Oracle has gotten its mojo back after kind of multiple years of not really being involved in the tech excitement, if you will. And I think they're doing a better job. I think they're getting bigger contracts with AI. And you've seen OpenAI say that they're part of the Stargate transaction that they've announced. You have also seen additional AI companies get behind them. They have an application business that's helping power human resources and financials for many of the top companies in the world. They've done very well against SAP and are fighting well against Workday. And I think that the biggest concern now is just the magnitude of that backlog growth, and then AI is expensive. And so we are below the street on margins next year. We think AI comes at a cost, and effectively, I don't think the street's modeled the margins right. So the risks are, can backlog growth continue, AI wins continue, and then is it going to be expensive, or are we going to drive margins lower in the short term? But I think the tailwinds for Oracle are better than the headwinds. And again, you look at the Trump, Musk, Ellison trio. They certainly have a good partnership. And so when the federal government decides to come back and spend money, Oracle's probably going to get one of the first calls. Obviously, they're part of Stargate, part of this government initiative.
Yeah.
And we're continuing to hear, better things there, and they're expecting accelerating revenue growth. We don't have too many accelerating revenue growth stories in software right now.
Yeah.
So we're going to go from high single digit to low double digit growth over the next year. So overall, I think it feels pretty good. Stocks, peaked out of 200. It's back at 148.
Right.
And so this pullback, we like the pullback.
So even if, I understand Stargate and whatever money the government might be trying to facilitate, and obviously in this administration, certainly good to be inside the White House, as Larry Ellison seems to be. On the corporate side, though, is there any concern about a slowdown in spending, some of the spending on data centers and other things that have benefited Oracle?
Not yet. We haven't seen it. And we've heard chatter about cancellations at Microsoft and this and that. And I think ultimately a lot of it's been noise, honestly. And I think many of these data centers require new infrastructure. So Microsoft may be canceling some contracts to go to data centers that they can actually use, or where there's energy or water. And so I think, overall, we haven't really seen a big slowdown. And I think there's this worry, and you see it in AI infrastructure with a number of these semi and hardware names off, that is growth going to slow? The answer is yes. There's no question, growth is going to slow, but we're still early days in terms of this improvement. So we're in my opinion, I think we're in a valuation timeout. Mm-hmm. Everyone's taking a little nap. Everyone's like, I can't own these things right now because they got too hyped and the multiples got too high. And so we're a little bit of a timeout, but I don't think this is the end of it.
Brent,
we're literally at the beginning of it.
Brent, very quickly, what would Oracle need to say to get a pop in the stock price today in after hours trade?
They got to put up over 50% OCI growth, continue to hold the revenue acceleration, and continue to highlight that demand is good and that you aren't seeing any corporate slowdown. We haven't seen any evidence of that yet. So as long as they do that, I think the stock's going to get a lift post this report.
All right, good stuff. Brent Thill over at Jefferies giving us his preview here for Oracle, which will be reporting earnings after the bell. And I noticed, Romain, that for the last 4 quarters, Oracle has fallen after its earnings once, and the other times it gained double-digit percentages.
Yeah, 11, 13, 11% in 3 of the quarters. Last quarter it fell. It'd be kind of interesting, though. I am curious just to see how much this whole Stargate and a government partnership actually ends up being a tailwind. Because at the end of the day, we haven't actually seen the cash from that. It's a promise. And obviously in this administration, it pays to be close to the president. So if he says you're part of the in club, I guess I would put some money in that, but I also want to see where the money's coming from.
Absolutely, and this is what it all comes down to. And of course, we'll be covering those results when they cross after the closing bell. Now, coming up on the close, how rising crop prices and tariffs are impacting fast casual brands like Chipotle. We'll be speaking with the CEO, Scott Boatwright, next. This is the close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. Romain Bostic here on a massive sell-off in the equity space and a massive buying going on right now in the Treasury market.
Yeah, I'm Scarlett Fu. We're looking at indexes off their session lows, so that's the good news. The S&P 500 paring its losses to 2.8%. The Nasdaq still down about 4.1%, even after coming off its worst levels of the session.
A lot of concerns about the economy, and you see that reflected in the commodities space here, particularly with crude oil down. And of course, when we talk about tariff risk, we've spoken so much about how much it's going to cost us to import goods from overseas because of potential retaliatory tariffs, but you kind of forget we export a lot too. And I thought Bloomberg had an interesting article today that talked about all of these unfulfilled contracts for agricultural exports that could be in jeopardy if Mexico wants to stick it to us. They buy $6 billion of corn from us. China buys obviously a lot of soybean and wheat from us, and there are some concerns here that they may decide to cancel or at least pare back some of those contracts.
Yeah, more than 11 million metric tons of grains have been sold but not yet shipped to our top 3 trading partners, China, Mexico, and Canada. Let's see how it all shakes out. Of course, President Trump has put on hold his plans to tariff Mexican goods and services that are covered under the USMCA until April 2nd, and then maybe new negotiations begin. We're not sure how it's all going to play out just yet.
I just want to know, Scarlett, if I can get my avocados or not.
Yeah, well, are you a big avocado fan?
I am.
All right, so am I. So let's talk a little bit more about avocados.
Avocado.
Let's bring in right now someone who knows firsthand how the price of avocados can change things up, and that is Scott Boatwright. He is CEO of Chipotle. Scott, welcome to The Close. Thank you so much for joining us today.
Thank you, Scarlett. Happy to be here with you this afternoon.
Let's start with tariffs, because we can't avoid the elephant in the room here. The single biggest way that tariffs are making your life at Chipotle more difficult.
Of course, tariffs impact everyone here in the U.S. As we think about, I know avocado supply is on the top of mind for a lot of U.S. consumers. It is for us, as you can imagine. We've gone through what we believe to be a very sound vendor diversification program as it relates to buying avocados. We buy everything that we can possibly pick up here in the U.S. During the growing season that's here in California. But we've also moved out of Mexico, which was about 80% of our supply, into other countries like Peru, Dominican Republic, and even Colombia, and reduced the reliance to about 50% with further diversification efforts underway.
So the diversification effort and the sourcing inside the U.S., how has that affected the cost? Has it increased costs for you?
No, actually, we've been able to maintain costs by bringing in other countries of origin, which has helped support our margin. Tariff impacts will be felt, as you can imagine. I said on our last earnings call, if all tariffs go into place with Mexico, Canada, and China, it will impact our margin by about 60 basis points in total. Not immaterial, but not the end of the world either.
You also said on that call, Scott, that you as a company were willing to eat that, meaning not necessarily pass that directly on to the consumer. You still stand by that?
I do stand by that, Romaine, and here's why. The consumer today, we recognize fully, is under pressure. Specifically, the low-income consumer is finding this economy tough to navigate, and we want to continue to deliver extraordinary value to our consumer, primarily because we don't know which of the tariffs will be transitory or which will be permanent. That all remains to be seen. So we're going to remain patient. We're going to continue to deliver great value for the consumer and ensure that the Chipotle customer feels that benefit when they come into our business.
And of course, a lot of your customers come to Chipotle specifically for that. They also come to it, as you know, Scott, for what's on the menu. And prior to you taking over, there was some tinkering with the menu. Obviously, now that you've permanently been installed in CEO since November, you've had a chance to now guide this going forward. When we talk about new product introductions, and more importantly, not just what the uptake is going to be by the consumer, but how you bring these products to the market at a cost that's going to be favorable to your own bottom line.
That's right, Romaine. We continue to lean into product innovation and what I believe to be the most meaningful, best-in-class version of what we can put forward to our consumer. We just launched Chipotle Honey Chicken. It's in restaurants today. You'll start to see that show up in national TV ads later in the week. It's a promising LTO. We feel a limited time offering, which tested off the charts as it relates to consumer testing back this summer when we ran it. It's a super exciting product. It comes in kind of sweet on the front end with a little back end eat. And what we do with LTO specifically is try to give the consumer something new and drive incremental transactions, as well as to get our current consumers to come in more frequently.
I look at your stock today, Scott, and it's down 0.1%, basically unchanged. You could even say it's up in a market that is down about 2.5%, in part because analysts have cited things like your enviable balance sheet, talking up your ability to have optionality when it comes to investing in stores or spending, as you mentioned, on technology and new developments. What is your single biggest priority when it comes to spending on development? Is it to continue to expand your menu? Is it something more internal, back of the house?
Yeah, it's a great question. So we think about every dollar that we have in the business today, and you are correct. We have an extraordinary balance sheet, a fortress balance sheet, if you will, very little debt, and probably $1.5 to $2 billion in cash. And we believe that preservation of cash is important to weather tough times just like this. So we'll continue to lean into new restaurant development. We said publicly we'll build 315 to 345 new restaurants this year alone. We'll continue our stock buyback program to deliver more value to the shareholder. But we'll also lean into what I'm calling back of the house modernization, where we're going to bring forward equipment innovation that has been in our stage gate now for over 2 years to help drive more efficiency in the back of house, create a better team member experience, which we know will always ladder to a better consumer experience.
What does that mean for hiring as you continue to expand that investment in the back of house operations? Because there's a lot of concern now that the labor market's going to get tighter if we see the pool of labor workers in the labor market shrink.
You know, as we stand here today and we head into what we call our burrito season, which is really springtime, we are better staffed today at Chipotle than we've been in my 8 years with the brand, perhaps in the brand's history. And I really think that's attributable to our best-in-class wages and our industry-leading benefits and what I believe to be a world-class culture that we've created around people development, and growth in the organization. We'll continue to invest in our most important asset, which is the 130,000 team members out in our restaurants, which I have said before, I'll say again, are really the backbone of our great organization.
Do you plan to expand the footprint of Chipotle, more stores this year?
We absolutely do, Romain. We're going to build 315 to 345 new restaurants here in North America. We'll have additional growth in Canada this year. We're looking at expanding our footprint in Western Europe. Our partnership with Al Shaya in the Middle East will produce additional Chipotle restaurants in that region. We're also looking at additional partnerships around the globe as I stand here today, really in this idea of really moving Chipotle into a global iconic brand.
All right, Scott, I really appreciate you taking time for us. Scott Boatwright, he is the CEO of Chipotle. When we come back, we're going to talk to another CEO, the CEO of Novo Nordisk. Excuse me, not the CEO, it's the head of development at Novo Nordisk. I should remember that because we just spoke to him just recently. The shares down here on the day, and this has to do with sort of what's next beyond Ozempic and Wegovy. They were working on something called CagriSema, and apparently in the most recent trials, it failed to meet expectations. Basically, the percentage of weight loss not quite as high as what the company had said. It was looking for 25% weight loss, and in the study only got it to about 15.
A lot of question marks about what's next in terms of innovation for this company, right? Or does it just lose out to Eli Lilly?
Martin Lange, he's the Executive Vice President of Development, not the CEO. We speak to him next, right here on The Close on Bloomberg. All right, the U.S. ADRs of Novo Nordisk are down here on the day. This after the company's next generation weight loss shot called CagriSema fell short of weight loss estimates in its most recent trial. Now, earlier today, we had a chance to catch up with Martin Lange. He is the Executive Vice President of Development at Novo, and we asked him about those results.
The study was a study in patients with overweight or obesity and diabetes. So in essence, obesity and diabetes. The comparator in this trial was placebo. What we saw as the primary endpoint was an almost 16% weight loss, 15.7 to be exact, weight loss in the CagriSema arm. These are among the best weight losses that we've seen in patients with type 2 diabetes. Type 2 diabetes patients have a little bit more of a difficulty losing weight than people without diabetes. So therefore, 15.7% is very substantial. This to be combined with the safety and tolerability profile that we saw with CagriSema that is comparable to that of the well-known GLP-1 class. So very interesting data, and obviously boding well and confirming the weight loss potential that we've already seen from CagriSema in REDEFINE 1.
And when we talk about the popularity of these GLP-1 drugs, we're basically talking about a drug that mimics a chemical, a hormone that's in your stomach. What CagriSema does is essentially introduce a second hormone into that process. One of your competitors is already working on another drug that introduces a third hormone into that process. If CagriSema, as a two-hormone process, fails to live up to expectations, what's next for you and Novo? Do you have something else to work on?
So first of all, we are quite happy with what we've seen with CagriSema, and we've also communicated based on the REDEFINE 1 data that we see a potential for a further weight loss with CagriSema, and for REDEFINE 2, that's the same dynamics. Currently, we have semaglutide on the market. It's a really good weight loss drug, but as importantly, it's the only anti-obesity medication currently approved that has a proven CV benefit in combination with the weight loss. That is currently in the semaglutide label, both for obesity and for diabetes. And obviously, when developing the next generation compounds, including CagriSema, but also our further pipeline drugs, we focus on the weight loss, but we also focus on the comorbidities.
Martin Lange there. He's Novo Nordisk Executive Vice President of Development, Scarlet Fu. He's not CEO just yet. But it's kind of interesting because he really is kind of the brains behind the sort of the process that these drugs have to go through, the testing and trying to figure out how we get it to market. They obviously had a big hit with Wegovy, which is basically just Ozempic, rebranded for the weight loss set. I don't know what's happening here. I mean, it seems like some people are upset about CagriSema not meeting these targets, but then he was saying, well, look, some of the numbers were actually pretty decent. Also, people were at lower doses, and I guess they weren't like at the highest doses.
It's all relative. That's what it comes down to, right? Because Eli Lilly's Zepbound had, performed a certain way, and CagriSema did not do better than Zepbound. Yeah. So by that measure, it underperformed. And
but
that
people
was the
still
market reaction.
Lost weight, right?
People still lost weight by double-digit percentages, but it has to do better than Eli Lilly's
But he talked about how for some of these types of patients, meaning diabetes patients, it's actually better if they lose it slower as opposed to what Ozempic and Wegovy can do, which is like kind of boom, you just drop 20 pounds like that.
It speaks to how competitive this market has really become, right?
Yeah.
All right, coming up, we're going to take you to the closing bell. We've got a lot more on the current market sell-off here. Anthony Saglimbene, the Chief Market Strategist at Ameriprise Financial, will be joining us next. This is The Close on Bloomberg.
You get to certain levels where people have been kind of complacent in their trades, in certain trades that have essentially relied on low correlation levels, high dispersion levels, relied on things kind of staying the same. And as you continue to sell off, I worry that that will trigger in and of itself something that is potentially worse, that unknown coming into the picture.
And a relatively broad-based sell-off right now. At least at one point on the day, we were looking at one of the worst days going back all the way to 2022, if you can believe it. That was Amy Wu Silverman who kicked us off to the close from RBC Capital Markets, Scarlett. And things really haven't gotten much better. We are off the lows of the day, but still deep in the red.
Yeah, highly correlated among asset classes today. Aside from the yen and treasuries that are higher, everything has a red arrow next to it. I'm looking at the Wilshire 5000, the broadest measure of the U.S. stock market's got about 3,300 members, down 2.7%. And then at the other extreme, the Mag 7 in a bear market now, down more than 20% since the record high on December 17th. All 7 names, as you might imagine, in the red.
Yeah, chip stocks also in the bear market. And we should point out, as far as the S&P sector, 6 of the 11 sectors right now in correction territory, down 10% or more as we move closer to these closing bells. Just about 8.5 minutes to go. Let's bring in Anthony Saglimbene. He's Chief Market Strategist over at Ameriprise Financial. And Anthony, 2 interesting things that jumped out at me today. I mean, everyone's talking about this is going to be the first time we've closed below that 200-day moving average on the S&P since, like late in 2023. This is also going to be the first time, should these conditions hold into the close, the first time we've actually closed in oversold conditions since October of 2023. And I guess my question is, when do these technical levels start acting as that trampoline for a rebound?
Yeah, it's hard to say. It's definitely a risk-off environment today. It's been a risk-off environment over the last couple of weeks. And I think you pointed out some really key stats, right? Semiconductors in a bear market. Mag 7 moves into a bear market today. You see the Nasdaq move into a correction. S&P 500 is getting close to that correction territory. And all of those moving day averages have been violated in all of those indexes. So over the near term, it looks like those conditions are not going to change and the volatility is going to persist as long as we have uncertainty around tariffs and economic policy. But I do believe that longer term investors can start looking at these levels, start putting their shopping list together and start looking at quality names that have been beaten up over the last couple of weeks, if your time horizon's longer than the next couple of weeks or couple of months.
Well said. And I do want to get to some of those names in a second. But before we do, I am curious as to whether you saw this coming. And the reason why I ask is, I mean, you put out your list of recommendations at the start of the year, and it was pretty defensive, at least that's my opinion. It looked pretty defensive to me. And you didn't have, and correct me if I'm wrong, any of the big cap tech names on there, certainly not on the Mag 7. So what did you see at the start of the year that maybe gave you pause?
Yeah, one of the concepts that we talked about coming into the year was this concept of guarded optimism, right? And you've heard it all week on some of the shows and all day today, where valuations were very high, stocks were priced for perfection, some of the valuations in big tech and some of the leaders of the market had been priced at really high levels. And so we had this concept of guarded optimism where if you did see lower taxes, lower regulations, and earnings growth start to accelerate in areas outside of technology, that could be a catalyst to lift stocks through the year. But one of the things that we talked about was this known unknown, which is the tariff drama that we're seeing right now, and the expectations that investors would pull back if they saw that macro environment come down a little bit. I think that's what we're seeing right now. I think the fundamental picture still looks good. I do believe that there is opportunity for growth in this economy. We should get maybe some prospects for lower taxes later in the year, and that earnings story is still pretty strong. So earnings growth is expected to be about 11.5% for the S&P 500. Areas like financials and outside of technology, but materials, consumer staples, their earnings look a little bit more stable. Healthcare. These are the areas that are acting defensive right now outside of technology, and they're the areas that still see some earnings growth for 2025.
So that's where I want to go. They're acting defensive right now, and I'm looking at telecoms, energy names, food, beverage, and tobacco, some utilities, household and personal products that are higher in today's market. Are these temporary hiding places while we get over this bout of volatility, or is there reason to stay in those names for the long term?
I think there's areas outside of technology that can make sense for the full year. So financials, where maybe see more merger and acquisition activity and IPO activity in the second half of the year. Consumer discretionary and staple, the high end of the consumer is still spending. So those trends still make sense. But I do believe that if you get too defensive in this market right now and miss maybe some of the opportunities where the secular growth engines of the economy, like technology, like some of the big tech companies and consumer discretionary and communication services, there will be a point where investors look at some of these stocks and say, you know what, I'm going to hold my nose and I'm going to go in and buy some of these stocks at lower valuations. I don't know exactly where that point is, but I do believe we'll see that at some point. And so you don't want to be totally offside in some of these areas that are really getting hammered today.
I think it's fair to say that investors have been taken aback by President Trump being willing to endure some short-term pain for the long-term gain of rebalancing global trade and shrinking the government, right? He calls it a period of transition or a little disturbance, whereas investors were using the Trump 1.0 playbook to think, no, he's going to come in and maybe support the market through verbal intervention. What are you hearing from your clients as they call you to try to make sense of how they should play out the next couple of weeks and months?
Yeah, they're certainly nervous. There's a lot of uncertainty. You're seeing it playing out in the market. You're seeing it in the sentiment surveys. You're obviously seeing it with clients and conversations that they're having about their investments. One of the things that we talked about was a well-diversified strategy should help you navigate some of the uncertainty that we're likely to see over the next few weeks and maybe even the next few months. Cash, fixed income, alternative strategies. These are areas that you can hide out and lower overall portfolio volatility. We talked about within equities being more defensive. And at some point, with that excess cash, using some of this uncertainty, maybe when we have a little bit more clarity around policy and tariffs and whether they're going to stick and whether this is just a negotiating tactic. Once all that clears, I think there will be an opportunity where stocks can rebound. But in the, kind of in the moment, you want to be well diversified, have some cash and fixed income, and use alternative strategies to help lower that overall portfolio volatility.
All right, got to leave it there, Tony. Anthony Saglimbene, Chief Market Strategist over at Ameriprise Financial. With markets deep in the red, we should point out we've seen a lot of buying in the Treasury space. Yields across the board, at least on the shorter end of the curve, down by about 10 basis points. We're below 4% on both that 2-year and 5-year. Your 10-year at 4.2.
I'm also looking at Tesla. Shares down about 16%. That is the most since 2020. Yes, there's some fundamental reasons like the pullback in sales estimates, but also that link to Trump.
The VIX elevated on the day, camped out around 28. A full breakdown of all of today's markets coverage starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through that closing bell with a global simulcast that starts right now. Tim Stenovic and Carol Master joining us in the radio booth. Alex Steele is on assignment on this day here. Stocks deep in the red, though off the lows of the day. 57.0537. Carol, was where we opened. And that was the high of the day.
Yeah, pretty remarkable. I think what's interesting, though, over the last half an hour, though, we have seen stocks come off their worst levels. I think it's really interesting to see whether or not we continue to see buying into the close. We've just got about a minute or so to go, or whether we start to see another leg to the downside.
We should know not everything is down today. If you look at the S&P 500, there are 25 stocks in the S&P 500 today that are actually hitting 52-week highs. Verizon, one of those. Altria, another one of those. AbbVie is hitting a 52-week high today. So is IBM.
Yeah, so some defensive buying, but when it comes down to it, the number everyone's looking at is a 200-day moving average, or I should say the line, and everyone's talking about how nothing good happens below the 200-day moving average. We could be closing below that level, and if we close again below that level tomorrow, a lot of people saying that puts us in a new regime. Yeah, well, it certainly looks like we are going to close below it here on this day. 57.34 is your 200-day moving average. The S&P right now at 56.07 and change, and we should also point out the index right now poised to actually close in oversold conditions for the first time in about a year and a half.
Yeah, pretty significant, right? Yeah. And, this is when you wonder, do buyers come in at this point, or do they kind of wait to see how it plays out over the rest of the week? Yeah, hard to do that, of course. So when you continue to hear this chatter out of Washington saying, look, folks in the White House, they don't care what the market's doing. They're playing the long game on the economy. It'll be interesting to see whether that actually comes to fruition. The closing bells in New York as people are obligated to chat and cheer, with the S&P down more than 150 points on the day, or roughly about 2.7%. The Dow Jones Industrial Average down almost 900 points, or 2% on the day. The Nasdaq Composite is going to close lower by 700 points, or about 4%. Similar move lower on the Nasdaq 100. And the Russell 2000 are also being dragged down on the day, down 56 points, or 2.7%. All right, quick check on the S&P 500. You had 341 names to the downside, guys, 162 to the upside, Scarlett. And given that the S&P closed down about 2.7%, you would think that all 11 sectors are in the red. That's not the case. Utilities gaining more than 1%. Energy also holding up by about 1% as well. Of course, they're among the two smallest sectors in the S&P. All right, let's get to some of the individual gainers, guys. Redfin, no surprise, up 67%, right? Rocket is buying Redfin, an all-stock deal, $1.75 billion is a price tag on that. Rocket paying $12.50 per Redfin share, so no surprise to see this one. Biggest intraday gain, probably biggest gain in total on record for that name. Another name actually gaining in today's section, Tractor Supply, at one point up 5%, but finishing the day with a gain of about 0.5%. Business Insider noting over the weekend that Mizuho analyst saying that faced with U.S. egg prices at record highs, shoppers are turning to Tractor Supply in large numbers to buy baby chickens of their own. So we did see a lift in that one. And Cracker Barrel, guys, up about 3.5%, being raised to a buy from hold over at Truist Securities, which views the company's solid results in the last 2 quarters as a sign that its turnaround plan is gaining traction. They upped the price target to 55 from 51, stock closing at 44 and change today. All right, you got the gainers, Carol. I got the decliners. I do want to start with the shares of Tesla. Its worst day going all the way back to September of 2020. Shares falling by more than 15%, reaching their lowest level going back to October of last year. And yes, that was before the U.S. election. Shares dropping today by 15.4%. Growing concerns about the company's deliveries. Joseph Spack over at UBS cut projections for the first quarter and the full year, expecting a 16% reduction in deliveries this quarter and a 5% annual drop next year. You got to wonder if shareholders are going to start demanding that Elon Musk get back to Fremont, California, or maybe Austin, and work more on Tesla. We'll see if that happens. Hey, shares of Apple also selling off today. All members of the Mag 7, Apple no exception. Apple, worst day going back to September of 2022. Shares down by close to 5%. At one point, it was the worst day since 2020. Separately, Apple did say it was delaying an AI-related update to Siri for the foreseeable future. And then this afternoon, Mark Gurman out with a Bloomberg exclusive, citing people familiar that Apple is preparing a major software overhaul to transform the interface of the iPhone, the iPad, and the Mac. The idea is that it makes the OSs more consistent and will simplify navigation. A lot of moves. Yeah, go ahead.
Go ahead, Al.
I was going to say, just finally, shares at Novo Nordisk down by 9.4% today. Those are ADRs. Martin Lange, I saw him on your air, EVP for development. We should note that Novo shares fell after the company's next-gen shot failed to meet expectations in a trial. Patients did lose 13.7% of their weight over 68 weeks.
All right, let's get a quick check on yields here. There was a lot of activity there, particularly on the short end of the curve, down 10 basis points on your 2 and your 5 year. Of course, the 2 year most sensitive to conditions, to Fed conditions, I should say, or changes in Fed rates. You had an 8 basis point drop on the 10-year yield and about 5 on the 30-year yield. And speaking of Fed conditions here, we talk about this idea of what the Fed might do next, guys. I mean, we've all been sort of focused on work. We came in, just barely a month and a half ago, and you had a market that was pricing in barely a quarter point of cuts all year long. Right now, that is more than 3/4 of a percentage point now being priced into this market. To be specific, right now, 83 basis points by the end of the year. So a big turnaround just in the past 6 weeks in expectations for Fed cuts.
And yet the expectations for next week, when the Fed meets and does puts out their latest views on monetary policy, they are not expected to cut rates. But it will be interesting. We get another read on inflation this week and whether or not it becomes trickier for the Fed, especially if we see or continue to see signs of slowing U.S. growth. And if inflation continues to be sticky, once again, we bring up, this idea of stagflation and how it makes it more difficult for the U.S. central bank.
Yeah, Michael McKenzie, who covers rates for Bloomberg News, was on our air a little earlier, and he said, obviously next week's meeting, not really seen as a live meeting, but investors kind of looking to signals that we get about what happens at the May meeting as a potential meeting for some rate movement.
I suppose the silver lining here is that a lot of people, economists, are anticipating CPI increases to slow for the month of February. Right now, we're looking at 2.9% year-over-year growth in consumer prices versus 3% in the month of January. And when it comes to University of Michigan in consumer inflation expectations, that too is decelerating just a bit.
And what's interesting too about all this too is this idea, and we're speaking with Amy Wu Silverman at the top of our show, who's talking about this idea. A lot of this stuff hasn't actually shown up in the data yet. Gina Martin Adams echoed that, and that's going to be a big concern right now, is that there's all these fears out there, but at least as far as the hard data, not showing up just yet. Correct?
All right, let's get to Oracle, just coming out with its latest results. Third quarter adjusted operating margin, 44%. That's a little bit better than what the street was expecting, 43.6%. Adjusted revenue, $14.13 billion. That compares with an estimate of $14.39 billion. And third quarter adjusted EPS, guys, $1.47 a share. That's 2 pennies light. And you do see the stock down about 0.2% here in the after hours. All right, guys, that is a wrap. We'll continue to track some of that earnings after the close. That's a wrap on radio, TV, YouTube, and Bloomberg Originals. We will see you again, same time, same place tomorrow for the closing bell.
And we continue our coverage here on Bloomberg Television, a closer look at the sell-off, not just a one-day sell-off, but really, now it's been a couple of weeks. You go back, of course, to late February, where there was a lot of discussion here about what the economic impact would be of policies out of Washington. Has that actually shown up in the economic data? Not yet. Has it shown up in credit conditions? Well, maybe. Let's bring Edward Altman into the conversation. He's Professor Emeritus of Finance at the Stern School of Business over at NYU. And of course, he developed the Z-score model for predicting bankruptcies, which throws a wide variety of things into the basket that I had to learn over and over and over again to get my CFA.
Great.
I think I know them now.
Great. You had to pass the test with that.
I did. Don't ask me to actually calculate that live on air. But I do wonder, it raises a big question that for all of the fear, for all of the anxiety in this market, have credit conditions actually gotten worse over the last few weeks or months?
Not too much, actually. Yeah. The spread or the risk premium that investors are requiring is up about 10, 15 basis points, not very much. Markets have been really resilient in terms of the credit markets. I think, and I've said this for quite a long time now, the market is underestimating the financial problems that were here even before the latest reasons for the market meltdown in stocks, mainly due to very high leverage in the system. And if you look at bank loans, rather than high-yield bonds, which is what most people look at in the credit markets, the default rate last year, for the whole year, was almost at record high levels. That's kind of not been known by most people. Look at bonds, and the bonds have been performing very well. 8-10% return, more than that the year before. But it's the bank loans that I've been following that have shown a lot of problems, but it hasn't been reflected in the required return.
With those bank loans, is that sort of broad across sectors, or is it concentrated in certain pockets of the economy?
Across the whole sector. We're talking about a 6% default rate on what's called bank syndicated loans. These are loans to non-investment grade companies. It was over 6% in dollars and over 7% in a number of companies. And yes, across the board, maybe some industries, healthcare, communication, having problems, but I didn't notice any particular area. And energy, for example, which typically has problems, was certainly not a problem in this case.
Do you subscribe to the adage that credit still leads in this kind of market when there's so much turbulence, so much uncertainty, big question marks over how the government's going to proceed with trade policy?
I do believe, and I think I'm in the minority here, that the relationship between the credit cycle and the business cycle is the credit cycle leads the business cycle. Most economists, financial experts would say the reverse. And I've looked at this over many, many recessions. I've been in this field now for a long, long time, more than 5 decades. And I track very closely the default rates on bonds and loans relative to when the next recession will be. And this is really an interesting situation now. The bond default rates are very low. That's because they're fixed rate, and they were issued during COVID for the most part when interest rates were low. The bank loan default rates were sky high, almost the highest I've ever seen. And that's kind of not been digested in the marketplace. So I do believe there are a lot of problems. And speaking about what happened today, I'm sure you know more about the stock market than I do, but I have a feeling it's just this huge uncertainty that's out there with respect to investments, with respect to investors, companies. It's the whipsaw that's going on that's driving the markets crazy.
Right, and you look at treasuries, I know that prices are higher today, yields are lower today, but they've been kind of all over the place for a while, and it makes it difficult to price equities if you don't know where the 10-year is trading. Is it easier to have conviction on corporate bonds than it is to have on the treasury market right now? I mean, companies offer earnings and guidance, and there's a little bit more near-term certainty there.
You know, it's something I've learned over the years is very difficult to forecast things like interest rates, currency levels, and bond prices. But it's pretty clear that when there's uncertainty, that there is a retreat to safety, and you probably know that, and that implies much higher prices for treasuries and lower yields. And that's been shown certainly of late, but not as much as a full-blown, meltdown would imply. And I'm very concerned about the consumer today. They're also quite uncertain. I'm uncertain in terms of interested in buying an apartment recently, and I decided not to. Just the rentals on it were probably very difficult to forecast.
I am curious, Professor, whether you see any sort of systemic risk. And when you talked about bank loans, I mean, the one thing that I thought about too was, how much direct lending we've seen in the private markets that to a certain extent are going to shield some of those potential defaults, and I'll just put that in quotation marks, from any sort of models that you can have, because we don't really know, and they tell us everything's all good. So is there a way to even gauge systemic risk right now reliably?
I think there is. And one market that I think is really important, but not necessarily there's going to be a tremendous amount of bank problems, is the private credit market. There are 3 main markets for, let's say, risky debt in the corporate sector: high-yield bonds, syndicated bank loans, and private credit, non-bank, shadow banking credit. Now, that market has grown dramatically, as you probably know. Some estimates now are $2.5 trillion outstanding. Some people think it's only 1.7, but it's higher than either bonds or syndicated loans. If there is a meltdown and I'm not saying there will be, in any of these markets, and even the private credit market, the question is, how important is it to banks? And I don't think it's that important, to be honest with you. Banks have loans to these non-bank credit institutions of about $550 billion. Let's say there's a lot of defaults in those loans. The exposure that the banks have is to lose maybe 50, 75, at most 100 billion, and that's not going to cause a systemic problem. It's got to be something else happening at the same time.
So you don't see any mechanism for that triggering a wider panic in the public markets then?
I mean, the private credit meltdown? No, I don't. In a way, private credit has filled a void that the banks have stopped lending to, let's say, more risky companies. But there is a lot of hidden problems in that market too. They have a great way, private credit, of restructuring the loan so that it doesn't default.
Yes.
And so we have to wait some time to realize how serious it is. And the market is more opaque. It's not as transparent as the public markets.
Yeah.
So, but my gut feeling is it's not going to be the private credit market that's going to cause a systemic problem.
All right.
Edward Altman, Professor Emeritus of Finance at the Stern School of Business at NYU. Thank you so much for joining us today.
Thanks,
My
Professor.
pleasure.
All right, let's turn back to earnings because we had just told you about Oracle. The shares are up about 2.5% in after-hours trading right now. This is even after its third quarter adjusted revenue did miss analyst estimates, $14.13 billion when analysts were looking for almost $14.4 billion. Let's bring in Sara Frier, who covers big tech for us. And Sara, I see that Oracle raised its dividend, but I'm guessing that that's not the reason why the stock is higher in after-hours trading.
No, it's not. It's all about the cloud. It's all about these big contracts that they have with OpenAI, with Meta, with all of these big tech companies to try to build out their data center infrastructure to fuel the AI boom. And we're going to hear probably that forecast from Oracle on the call with shareholders coming up in a bit. But for now, we have statements from Ellison and from Safra Katz in the report just talking about how vast this build out is. They're doubling their data center capacity for the rest of the year. They have huge contracts looking into the future, many billions of dollars that are going to come in. So investors aren't looking at Q3 as much as they're looking at the road ahead and how critical a player Oracle is going to be in the AI build out.
All right, Sara Frier, they're out there in San Francisco. Oracle shares up about 4% in the after-hours trade. Let's bring Dan Niles into this conversation, founder and portfolio manager at Niles Investment Management. And Dan, I do want to just get your take overall on the AI spin, because it seemed like for a few weeks we were all kind of freaking out after DeepSeek and saying this was going to disrupt what the hyperscalers were spending, what the other companies out there that were buying these products and investing in these data centers were spending. At least based on what we've seen in some of these earnings reports, including today from Oracle, there does not appear to be any material slowdown in that spend.
I would disagree with what you just said, quite honestly, because if you look at what a lot of the major companies came out and said, what people assumed and what the media took away from it is, oh, spending is great. But if you actually look at it on a sequential basis, a lot of the spending is dramatically slowing down. Where if you look at Microsoft, it looks on the surface like their spending is up 50% over their fiscal year. But on a sequential basis, the spending's actually flat. And so same thing with Oracle, where on a fiscal year basis, their fiscal year ends in May. It looks like CapEx is up over 100% year over year. But when you look at it on a sequential basis, it's actually down. So there are a lot of things going on underneath the surface, but the biggest one is, quite honestly, revenues. And you just talked about it earlier, right? Oracle came in below expectations on the top line. And so at a certain point, all of this money you've spent over the last 2 years, is it generating revenues? And looking at it more broadly, there's a reason the Magnificent Seven are down 15%, 1.5 year to date. And that's because 6 of the 7 companies that reported, their estimates for the March quarter all went down for revenues. And for NVIDIA, the numbers edged up slightly on a top line basis, but the gross margins were cut, which is probably the most important metric for a semiconductor company. So this is a problem with U.S. tech earnings. People want to blame this on tariffs.
Yeah.
But if you really thought they were tariffs that were causing this problem, then Mexico's stock market wouldn't be up 7% year to date. You wouldn't have the Eurozone stock market up 15% year to date, and the emerging markets wouldn't be up as well. And foreign tech stocks like the internet, tech stocks in China, so if you look at KWeb, for example, that's up 21% year to date. So people I know are trying to blame this on tariffs, and there's nothing wrong with earnings, but there's actually is a problem when 6 of the 7 biggest companies on the planet have revenue estimates go down for March. That's what the issue is.
So do you expect that that downdraft to accelerate? I'm talking about with regards to the Mag 7.
Well, I was already worried coming into the year. That's why I had cash as one of my top 5 picks for the year. And I said, you know what, if everything goes perfectly, the S&P could be up 10%. But with some of the uncertainties introduced, I could very easily see it down 20, which is why I recommended cash as one of my top 5 positions. With all this uncertainty being caused, and given reciprocal tariffs only come in on April 2nd, remember, that's near the end of the quarter for most companies, and most companies do a much greater than pro rata share of their business in the last couple of weeks of the quarter, so last couple of weeks of March. So I think guidance could be a big issue, which is what I wrote about on Sunday, could be a big issue as these companies guide out for the June quarter. And multiples were high coming into this year, which is the big issue. Multiples in Europe, China, emerging markets were all low. That's why you see those markets up, even though theoretically they should be getting hit.
So I like your take here because it gives us something new to work with here. You say that this is a problem with U.S. tech earnings. Is it a problem with U.S. big tech earnings, meaning beyond the Magnificent Seven? Is there anywhere in U.S. tech where the earnings look reasonable? They look like they offer value, that it's still a good time to get in?
Here's the thing. When you're going through a deleveraging event like you are now, and the big tech companies have been really driving growth because everybody assumes you can't lose in the AI trade, right? Well, all of a sudden, when you're down 25% in a month, and if you're really working the math, you go, well, you know what? It's not actually generating top line revenues. You have to be careful about the names that are smaller that are underneath this because Mag 7 might be down 25% in a month, but I've got some tech names that are blowing out numbers that are doing very well that are down 50% in a month because the valuations just got so astronomically high on the back of this tech trade. So, you know, investors have been sort of trained into this buy the dip and every dip's a buying opportunity and fear of missing out. But and I would not be surprised to see a big financial player. Don't forget, you know, some people may have forgotten about Archegos filing for bankruptcy in 2021. For those with longer memories like me, you remember long-term capital management, the late 90s. But there's a massive amount of pain being inflicted in the financial community. And a lot of these portfolio managers never lived through 2001 and 2002, never mind 08, 09. So that's the next phase of this potentially, which I'm concerned about.
Dan, you're saying that you're expecting a big fund to blow up because of the drawdowns that we've seen in these tech names?
Yeah, I think you certainly are going to see it. I've already heard about, you know, what they call pods within some of these bigger market neutral shops where you're supposed to be hedged, but then you make the returns using leverage. You've already had some of them being forced to degross, take down their position sizes because a lot of them are in all the same trades. And so that's why when you're looking at the market, you're going, you know, what's going on? Because a lot of these firms, they generate the returns by using leverage and they have all these models that are supposed to take away the risk. But I think for some of us with longer memories, we all remember long-term capital management where you have Nobel Prize winners running that shop. And all of a sudden it goes to zero and it threatens the entire financial system. So there's a lot of forced selling happening right now. I'm hoping we're near the end of it because like what I said earlier, if you go back to like 2022 when there was a real growth problem, a lot of those markets we talked about, whether it's Canada, the Eurozone, emerging markets, the US was down 19% in 2022. Sorry, 2020. 2022. But all those markets were also down 15 to 25%. This time around, those markets are up, which makes me think this is not a systemic problem.
Yeah.
But we're going to have to see, how this plays out.
Dan, really appreciate your joining us. Dan Niles is founder and portfolio manager at Niles Investment Management. All right, let's continue the conversation here with the sell-off we see in equities. The S&P 500 closing down more than 2.5%, 2.7% lower. Our next guest posing the question, is the bull market in detox or melting down? Jonathan Levin of Bloomberg Opinion joins us now. Jonathan, make the distinction here between meltdown and detox.
Yeah, well, I don't think we know yet, but I think what we have to recognize is that momentum is definitely going in the wrong direction for us here. I mean, over the last 2 years, I can't tell you how many conversations I've had about, what is driving this unstoppable train that keeps pushing valuations forward? Is it the rise of passive? Is it the fact that there were no other options in international and all this international company was coming to our shores? I don't really know what the answer to that ever was, but I can tell you that all of those factors all of a sudden are sort of going in the other direction. And so in my column today, I sort of pivot off of the fact that we're blowing through the 200-day moving average as a little bit of a wake-up call to say, if momentum is self-fulfilling on the way up, it can also become self-fulfilling on the way down.
Well, there's a question then, Jonathan. We talk about this idea of sort of what drove it up and the idea of what's driving it down now. What provides that bounce? I mean, we've hit key technical levels, and I don't know if you were listening at all to our previous conversation with Dan Niles. He also seems to be alluding to the idea that at least once you get beyond some of the big cap names, that there is profit growth, there is revenue growth, something we saw earlier today on this program from Gina Martin-Adams.
Yeah, exactly. A great appearance from Gina. But again, Gina pointing out the fact that expectations for earnings this year are just so high. By the same token, valuations here, they're not ridiculous. They're not .com level ridiculous or anything like that, but they are high. And so all of a sudden, when you have the momentum going in the wrong direction, when the policy winds are blowing in the wrong direction, I don't think that there is an obvious floor here. I mean, sure, we'll get some bounces along the way, but when the president of the United States is out there running a trade war and there's all this uncertainty around federal government layoffs, I think it's pretty natural for investors here to keep selling first and asking questions later.
What was interesting about what Dan Niles said was that this is a problem with U.S. tech earnings. People want to blame tariffs, but he sees issues with earnings. Talk a little bit about earnings, because there's certainly, when you look at valuations, on the high side.
Yeah, exactly. I mean, look, a metric I always look at really closely is what's going on with aggregate price targets. I always want to know when the fundamental momentum is starting to shift ever so slightly, because I'm not as in the weeds on tech earnings as Dan Niles is, but I like to see what the crowd is thinking. And I definitely took note in recent days when our aggregate 12-month price targets for the S&P 500 started rolling over ever so slightly, right? So this is a number, again, that forever and ever over the last 12 to 18 months, this is a number that has only gone up. But all of a sudden, the folks who are looking deeply at the fundamentals are seeing that there are some slight reasons for shakiness here. And, just that little wobble, it feels to me like it's enough to maybe push us a little further in the other direction.
All right, Jonathan, great stuff, and another great column out of you, Jonathan Levin of Bloomberg Opinion. A closer look here at what drove that big market rally, and more importantly, what's been driving the sell-off over the last couple of weeks. And Scarlett, I mean, Dan Niles is kind of saying, well, is this really about tariffs? I mean, yeah, it is. I mean, but he's also saying, look, there was a lot of weaknesses in this market prior to all of this, something that Altman also sort of alluded to as well, and that might actually be a big part of why we see such a big downdraft.
And to Dan Niles' point about how this is an earnings story, Delta has just come out, and it's lower in after-hours trading because it's cut its first quarter adjusted EPS forecast. Mm-hmm. And it previously saw 70 cents to $1. It's now looking for 30 cents to 50 cents. So
and there's a downgrade. And obviously that has a big connection to the travel sector, a big connection to discretionary spend. When we come back after the break, we're going to continue that conversation. A conversation with Adam Stewart. He's the CEO of Sandals Resorts, and that's coming up next here on Bloomberg.
And just to recap the latest earnings, or I should say pre-announcement from Delta Airlines, it is falling in after-hours trading. It sees first quarter adjusted EPS at 30 cents to 50 cents. Previously remained, it saw at least 70 cents to $1, and analysts were looking for, on average, 83 cents. So this is worrisome in that Delta caters to the premium part of the U.S. airline market.
Interesting, too, when we talk about operating margins and the idea that they're slashing that forecast down to a range of 4 to 5%, down from 6 to 8%. And remember, Delta and American particularly had been kind of the bright spots in the airline space here. Not only resiliency when it comes to business travel, but obviously a lot of resiliency when it comes to leisure travel.
And you can see United and American following Delta lower right now in after-hours trading. We're going to stay with the travel theme here because another company reporting earnings this afternoon is Vail Resorts. This is the ski resort operator. It updated its full-year guidance and higher in after-hours trading as a result. Chris Palmeri is team leader of media and entertainment for Bloomberg News. Chris, tell us what we need to know here for Vail.
Yeah, well, good numbers all around, and I think you could tie this to a restructuring they did last fall where they let go about 14% of their corporate workforce, and you're seeing that in the profits. You're not seeing it in a real surge in visitors. This is a better ski season than it was the season before where weather really didn't cooperate. But what Vail said is that they're not getting all of those sort of destination travelers. They're getting more locals coming in, and so the skier visits have not been robust.
I'm curious, too, just about costs and the idea. Anyone who's gone skiing knows that ticket prices have been going up. In the most recent quarter, though, their ticket prices actually came in a little bit less than what the street was looking for, $83.16 on average versus the street estimates of $85. As someone who skis prolifically, I've not seen that discount. Where's it coming from?
No, and in fact, it's unusual because the price for the annual pass, the Epic Pass, is up 7%. To $1,000 next season. So they've been raising prices and continue to do. That may be a reflection of more people coming or on the pass plan as opposed to buying that higher price walk-up ticket. Mm-hmm. And so maybe that's why the average ticket prices decline.
Yeah. All right. Chris Palmeri, our man there out there in California. A closer look at Vail Resorts, ticker MTM. And we go from the ski slopes to the beaches. Our next guest says that this year offers a great opportunity for increased travel. And this is despite some of the consumer concerns that we're talking about when it comes to spending, at least here in the United States. Adam Stewart is the executive chairman and CEO of Sandals Resorts. And as you can see, he joins us here in Studio 2. Welcome to chilly New York.
Thank you.
We're going to get you back down to the Caribbean in just a minute. But I am curious about business. We talk so much here on this program about consumer spending and the strains on that spending, at least when it comes to discretionary items. How does that affect Sandals? I mean, how far in advance are you booking guests?
So we book about a year out. Mm-hmm. So of course, everything affects leisure travel. Mm-hmm. Caribbean is fascinating. It's close. It's safe, and we've seen a steady, post-COVID. Mm-hmm. 22 was the revenge traveler. Mm-hmm. 23 cool off a bit. 24 a little bit more. We've seen 25 be really, really strong, and looking forward out to 26, 27.
If you do see a downturn in the U.S. economy, does that have a direct impact on you, or is that something that takes a while to sort of trickle into the bookings?
It takes a little while. You can feel it. We do about 60% of our business direct. We're very strong with travel advisors, mm-hmm. travel agents. So you can see it quite quickly on the direct side if it's momentous. Mm-hmm. But it doesn't happen overnight. People sort of ride the wave with a leisure product like ours.
Do you rely strictly on U.S. consumers, or are you branching out to cater to consumers in other parts of the world as well?
So the United States is number one, always been. It's close, it's the largest economy in the world, the greatest friend to the Caribbean. And of course, Canada's behind that, United Kingdom, and kind of rest of the world. But primarily the Caribbean tourism market is built on the United States.
Okay. And when it comes to the dollar providing kind of a tailwind for those U.S. consumers, how are you seeing that change as the dollar's strength kind of starts waning?
Overall, the Caribbean is a fascinating product, and Sandals and Beaches Resorts, we really do well in the upper premium side of leisure travel. We've been pioneering the all-inclusive segment for the last 4+ decades. We're 44 years old this year. We're a private company. We just keep innovating, giving customers more magic, showcasing the best of the four corners of the Caribbean with the U.S. consumer. And it's worked well for us over the years.
What's changed about the industry over those 44 years? I mean, is the consumer, or at least what they want now, is that different than what they would have wanted 20,
Absolutely.
30 years ago?
Yeah. The segmentation. So you're seeing in the all-inclusive space the way we do it, the premium side of things. Mm-hmm. So over-the-water bungalows and restaurants, over-the-water gastronomy, entertainment. the islands themselves, the fascination of exploring off-resort. Consumers are far more educated today than they were 20, 30 years ago through the advent of social media, the internet, and they're explorers. And the Caribbean has so much mountains, rivers, beaches. It's got it all.
What do you worry, though, about competition? I mean, we live in an era, and I'm sure you wear this, somebody posts something on, social media. I went to, Vanuatu or somewhere else, and then everybody decides they have to go there. And then all of a sudden that's at the expense of going to, Paris or Jamaica or wherever.
Look, we're all fighting for the same dollars. We're champions of the Caribbean. We believe in the Caribbean. My family founded this company in 1981. And, I'm a sixth-generation Jamaican. And so we fight relentlessly for what we believe in as the Caribbean. We believe it's the most beautiful part of the world. And, of course, we're fighting for dollars against Europe and Paris and Walt Disney World. They're all fascinating, but the Caribbean, we think, shines a little brighter.
You kept saying your value proposition is the all-inclusive experience, but costs are going up, and that's unavoidable. How much of that do you pass on to your consumers? How much pricing power do you have to increase costs every year, increase the cost of the package every year?
So ADR's average daily rates this year, we're seeing upwards of 5% up. A business like ours, as a Caribbean business, the linkages, connectivity, whether it's farmers or fishers or even the pastors and priests that officiate our weddings and special ceremonies on island. We do everything to maintain costs as best as we can. But of course, the ADR, the ADRs have still been strong in the all-inclusive space. The all-inclusive is there's multitudes of segments within it. We sit at the top as the most premium. And what we find is the more interesting, the more broad restaurants, entertainment, room design, accommodation, the more we do stuff that's spectacular, we find the consumer response.
How do you continue to innovate to offer regulars who come back to Sandals year after year something different each time and make sure that the price increase, that 5% increase, more than covers that?
So I think we're a fascinating hotel company. We own all of our assets. We own the brand. We're the management company. We're fully vertically integrated. We can invest.
And those are your physical assets too.
Yeah. So we can, we move on a dime and we make sure that every year our customers come back. Over 45% of our customers are repeat clients year after year. We have a policy that they should come back every year and see their dollars at work in the resorts. And that's what's kept us ahead of the game for the last 4 decades.
I had to ask you, though, as a Jamaican and being based down there, how is the economy doing? We talked a lot about Jamaican economy a few years back when it was roaring. The stock market was like the best stock market on the planet. Things have subsided a little bit here. I know your company and obviously tourism overall is a big part of that economy. How healthy is it?
Let me tell you, Jamaica is having its moment right now. We have the lowest unemployment ever in my generation. We're down below 4%. We have $5.5 billion US in the National Reserve, which is unbelievable. Our debt to GDP ratio has gone from 150% in the last decade to 68%, trending to 60. We're one of 2 islands in the Caribbean that are net positive on unemployment, on earnings, and on debt. We have no new taxes in the last 10 years through both sides of the political divide. And the democracies of the Caribbean are alive and well, and they are a shining example of progress.
All right, I think that's a great place to end it. Adam, really appreciate you coming on.
Thanks so much for having me.
Adam Stewart is the Executive Chairman and CEO of Sandals Resorts.
And again, just to recap, after the market close, we did hear from Delta, which downgraded its full-year outlook, and that stock is lower in after-hours trading, perhaps indicating that parts of the market tomorrow may decline. You have the S&P 500 closing the day down 2.7%, the Nasdaq lower by 3.8%, getting ever closer to a bear market, at least for the Mag 7. That would be a 20% decline from its all-time high. And the Russell 2000 remain also under pressure.
Yeah, it'll be interesting to see kind of whether we do get a rebound, but I think it gets to this idea of what Dan Niles was talking about. What was the reason for the sell-off? If it was indeed about tariffs in the economy, maybe this gets worse. If it was something more akin to what's been going on with big tech and a rotation out of that, then maybe we do see some nibbling tomorrow.
All right, there's certainly plenty of nibbling when it comes to the bond market. Yields are lower. This is The Close on Bloomberg.
been a wild day on Wall Street. You're looking at some of the biggest declines that we've had in months. It could have been a little bit worse, Scarlett. At one point, we were actually having the worst day since 2022. The Nasdaq 100 did close at its lowest level since 2022, but we did see a bit of a rebound in the S&P 500 as it broke through a lot of those key technical levels, including that 200-day moving average, and a close in oversold conditions. That RSI, that 14-day RSI, now below 30.
So I was looking for things that actually gained in today's trading. Treasuries, whether it's short-term or longer-term, so yields are coming down 11 basis points for the 2-year. And also, you have the yen gaining, so there's that. But beyond that, you look at Bitcoin, a risk asset to be sure, now below $79,000. At one point, it got to $77,000. Investors really looking past all of the excitement over the U.S. Bitcoin reserve.
Yeah, kind of interesting that did not quite provide the bump that was here. But there's going to be a lot of focus right now on the earnings picture. We were just reporting just a while ago here about Delta and that warning that it gave us. AT&T now out with the statement saying it's actually sticking by its 2025 guidance, saying that it remains on track to meet that multi-year outlook. So it'll be interesting, Scarlett, over the next few days and weeks here, which companies come out and basically throw in the towel and which ones say, hey, look, things are okay, and we're going to make out okay for the year.
And we should note that AT&T, by the way, finished up on the day 0.6%.
That is right. All right, we're going to turn now to the White House, where U.S. Interior Secretary Doug Burgum had to sit down a little bit earlier with our very own Alex Thill down at a conference in Houston, where he talked about renewable energy and how to make it more affordable.
You've been reviewing offshore wind in terms of the existing leases that have already been doled out. Are you any closer to deciding if those companies and those projects get to keep the leases?
They're all under review, and including onshore wind is also under review, not just offshore, but we're starting with the offshore wind because, of course, that's sometimes 3 times as expensive. And part of what our goal here for Americans is to have lower cost, affordable, reliable energy.
Right, but if the company already has, say, power purchase agreements and they already have their contracts lined up and their permitting lined up, why would you take that away?
Well, I think that's part of the review. We've been instructed by an EO to take a look at all of that. But in some cases, if we've gone so far out of balance in certain of these RTOs, regional transmission organizations, where we've got too much renewable and not enough baseload that's part of what's putting the grid at risk. And we've got to make sure that we've got the right balance.
Okay, so when do you think the review will be completed?
We've got a open end on this thing. We're going to make sure we do a thorough job on reviewing those projects that are underway.
When we switch then to other forms, a big part of this is going to be obviously permitting and being able to move the energy, whether or not it's a liquid form, whether or not it's just power. If I'm a company and I'm looking at what the administration is trying to do, what's the confidence level that all of this permitting, legal issues, putting pipes in the ground can be done in 4 years?
Well, it has to be done sooner than that.
And usually it's like 20 sometimes for a pipeline.
Right. Well, those days have to be over, because if you've got a national energy emergency, we've got to figure out a way to actually deliver. In this case, one of the things we ought to be able to do is we've got to be able to deliver low-cost, clean U.S. natural gas to all corners of the lower 48. I mean, we've got a situation now where we've got New England states that might be gas prices there might be 4 times higher than Pennsylvania, because we can't complete a 124-mile pipeline across the state of New York. So again, if you're in a national energy emergency, at the time of the Russian invasion of Ukraine, we were offloading 400,000 barrels of oil a day of dirty Russian heating oil into New England. I mean, 80% of the people in the state of Maine and 40% of the people in New Hampshire are still heating their homes with heating oil. We can do better than that for these citizens. They ought to have the same right and the same access to LNG that someone does in North Dakota, Pennsylvania, or Texas.
And that was our very own Alex Thill sitting down with the U.S. Interior Secretary Doug Burgum. A lot of question marks over the investing in our energy needs remain at a time when the Trump administration is working hard to reduce government spending overall. Yeah, and it'll be interesting to see. I mean, in fact, if there's any ace we have up our sleeves right now, it's probably energy. I mean, we talk about obviously being a net exporter now of energy, particularly when it comes to natural gas. So interesting to see if that can blunt the impact of some of the other policies. All right. Well, speaking of policies, let's talk about the Chinese-U.S. trade war that's happening right now, because Chinese tariffs on U.S. agricultural goods began to take effect today. Those tariffs of up to 15% hit products from beef and poultry to grain. And of course, it marks the latest escalation in the tit-for-tat trade war between the world's two biggest economies. Joining us now to discuss is Sara, Clinical Associate Professor of Supply Chain Management at the University of Tennessee at Knoxville. And Sara, what strikes me as really interesting is, as confused as people were and are about whether tariffs on Mexico and Canada will go forward as planned, what are the carve-outs, there's been no questions when it comes to tariffs on Chinese goods and China's reciprocal tariffs on U.S. goods. Who does this hurt more right now, the U.S. or China?
Well, it hurts both Americans and Chinese. So there are impacts that are happening on China. China's going through a period where it has really low consumption and slowing growth. And it's really just trying to keep up the pace of its economy. So higher prices for China and these retaliatory tariffs are not going to help the situation at all. At the same time, it's going to hurt the U.S., especially U.S. farmers who rely on many of these exports to China to provide them with a regular income.
Right. So it's a lose-lose situation for now. We also hear reports, the Wall Street Journal, for instance, reporting that Washington and Beijing are beginning talks about a potential summit for Xi Jinping and Donald Trump in June. Do you presume that these talks are aimed at reducing some of these tariffs, or now that they've been imposed, these are kind of going to be permanent tariffs through the duration of the Trump administration?
Anything is possible. When it comes to the tariffs, we've seen a lot of movements like back and forth, especially with regard to Canada and Mexico. So we don't really know what's going to happen between the U.S. and China. I think that tariffs will be an issue. They have been marked as a major issue, and I know that the Chinese government for certain has it on its radar as part of its policies that it's addressing. What comes out of it is anybody's guess, probably some sort of deal, but we don't know whether that deal is going to really benefit American farmers or whether it's really going to walk back some of these tariffs. It's really uncertain at this point.
One thing I'm curious about, Sara, is the idea of substitution. We talk about all these tariffs, and it's just such a wide variety of goods right now. And I know that people are looking for workarounds, but are there sort of viable substitutes to this, whether you're trying to get a load of copper or a load of corn or your car, from across the factory into the U.S.? I mean, what are the alternatives right now?
That's a really good question. I mean, everybody is looking for substitutes at this point. And so what that does is it raises the price of substitutes. And substitutes are also constrained. A lot of them are constrained through existing supply chain relationships. It's really hard to suddenly grow a market where you're importing directly from another company. That takes from another country. That takes years to build up, switching from, reliance on China or Mexico or Canada to a place like Vietnam or Brazil. That's a matter of 1 to 3 years. And so I think that it's going to be a bit painful, and people are going to face higher prices even in those substitutes.
Is this sort of the start of a permanent shift, though, in that sort of trade order? The idea, obviously, the U.S. has been trying to nearshore, if not completely onshore, some of its manufacturing. Other countries have also taken a similar tack in trying to insulate their economies. And I'm wondering if this is just sort of a Band-Aid as we get through this problem, or if this is just a material rethinking of our global supply chains, where everyone, whether it's for economic reasons or national security reasons, feels like at some point or another we have to do this within our own borders.
Yeah, I think, that's a really great question. And, we've had this trend of globalization for 30 years, and now there's a lot of kickback on that. I think that, the trend looks like going towards more protectionism overall, especially due to the whole idea of retaliation. But I do think that it will over time subside. And a lot of economists have talked about this regionalization, which you mentioned, where countries are dealing with their neighbor countries rather than trying to source from really far distances. And that was something that came out of COVID in particular, is that you don't want to be in the U.S. trying to source from a country that has shut down its borders. So you might go to, that country plus another country to diversify your supply chain.
We talk about substitution. To what extent is China looking and succeeding in finding replacements for U.S. grain, U.S. poultry, U.S. beef, and basically able to remove the U.S. from its supply chain completely?
I think that, China has been trying to do this after President Trump's first term, we saw China shifting towards importing from other countries and also exporting to other countries. And so this goes along with that trend. It is difficult to replace everything, but that's certainly something it's looking to. China also has a surplus in some areas, like with pork. And so that the tariffs actually might help them in that case. Although in other areas, sourcing soybeans, for example, might be more difficult for them to find alternatives.
All right, Sara Hsu, really appreciate your joining us. Sara Hsu is Clinical Associate Professor of Supply Chain Management at the University of Tennessee over at Knoxville. Romain?
Yeah, and it gets to this idea, Scarlett, too. I mean, this idea of what the Trump administration is trying to do and the way they're articulating as this is some sort of big reset or detox, whatever phrase they want to use, and it's going to take some time. But I also sort of wonder what these other countries, I mean, they're just not going to sit around and wait, are they?
No, they're moving on. They're finding different alliances. They're coming up with their own solutions.
But they can't move on. We're America, Scarlett. All right, in all seriousness here, this was a pretty brutal day on Wall Street, and a lot of people really trying to figure out what tomorrow will hold. We're going to set you up for what to watch over the next 24 hours when we come back. This is Bloomberg. As this market looks ahead to what tomorrow may bring, we have a lot of earnings, economic data that could actually move the market.
We're going to focus on the consumer, right? Because Dix and Kohl's will be reporting, and it's all about what they see in their forecast, how they anticipate consumer spending.
Yeah, and I would think that with these particular companies, they would be maybe a little bit more insulated from economic concerns. I mean, they're relatively affordable value type plays.
Yeah, but they also rely on a lot of imported goods,
Yeah.
so their costs are going up.
That's a good point. We're also going to get a read on small business sentiment, the NFIB number out at the bright time of 6 a.m.
Yeah, well, this is for January, and it's expected to post a second month of decline. Of course, after the election, there was a lot of optimism, but that has turned.
Yeah, it'll be interesting to see what that says. We also get the JOLTS data here on job openings, which are coming after the big jobs report that we just had.
Yeah, so, I mean, there's a little bit of a delay here. We
Yeah.
know that the labor market is slowing down, but it's still holding up pretty well.
And over in China, the NPC actually is going to conclude. Are we going to learn anything?
Well, the government has already announced all the fiscal support measures, so let's see if the stock market rally continues.
All right, tune in with us tomorrow right here on The Close. This is Bloomberg.